Hi everybody, welcome to our latest 4x4 virtual salon, in which we're going to be discussing the democratization of wealth management. Okay, and so for those of you that are new to this format, the 4x4 virtual salon is so called because we have 4 speakers, who I'm going to introduce in a second. We cover 4 topics, which for this 4x4 will be changing customer trends, changing technology, new business models, and the new fitness landscape for wealth managers. For each of those topics, there's a poll. So if you can see on the portal there's a poll which you can complete anytime, and we will make reference to the poll results during the conversation. And then last but not least, we'll take 1 audience question per topic. So if you have a question, please post your question in the questions portal. Okay, right, so we're going to kick off. So I'm going to introduce our 4 speakers. So I don't know if this is how it appears for other people, but I'm going to start with my top left, which is Nikolai, who is Head of Strategy and Partnerships at Nucoro. So Nucoro, which is based out of the UK, has followed the make yourself the first customer route to market. So Nucoro launched an automated investment service called Exo Investing in the UK. And then it now offers the platform to others. Its platform is pretty broad, and it allows financial institutions to build a range of fintech money management propositions, everything from automated investments and stock trading to digital wealth management. Next, we have Mike O'Sullivan, who I think doesn't need such a big introduction because he's a veteran of the 4x4 virtual salons, having appeared last year on the one we did on post-pandemic wealth management. But for those of you that don't know Mike, he is a former CIO of Credit Suisse. He's the author of the much recommended book, The Leveling, which is about the world after globalization. And if you're interested, we also have a podcast episode with Mike on that topic. And then last, he's also a serial entrepreneur, an investor, and a board member and advisor. Which brings us, I think, nicely to Qiaojia and Rosecut, because Mike is an advisor to Rosecut, and Rosecut is a London-based automated investment manager. It's 2 years old. It has a very interesting customer acquisition model because it has a freemium service where you can access some of the tools and simulations and content to help you manage your financial affairs. But if you want Rosecut to manage your investments, then there's a 1% fee for doing so. The average AMU of a Rosecut user is £200,000. So this is not an ordinary automated investment service. This is very much a premium automated investment service. And then last but not least, we have Sid, who is head of product at Hydrogen. Hydrogen is a banking as a service platform helping brands embed banking services into their proposition, including wealth management services. And to do that, it works with a network of partners, including Cross Riverbank in the United States and Stripe. Okay, so, right, let's begin. So, as I said before, the first topic is changing consumer trends. And Qiaojia, we're going to kick off with you, if that's all right. And I wanted to ask you, how big is the opportunity that gets opened up by using automated investment services to target affluent or mass affluent customers? By how much can we increase the size of the wealth management industry by using automated investment services?
Thanks, Ben, for the question, and glad to be here. I think this is a very interesting question because from the tech perspective, I think everyone wants to invest, and everyone deserves to invest, maybe with £1, with £10, and it is made possible, in the past 10, 20 years by a lot of the first generation robo-advisors. But if you look down, in terms of the slice of the market of various segments, that's called like high net worth, affluent, and retail. Based on the Credit Suisse Global Wealth Report, actually Mike was part of the key contributors to that. It's in the UK, 1% of the population, the top of the pyramid, owns 3 trillion assets. And the next segment, 15% of the population, affluent, owns another 3 trillion assets. And the remaining 85% of the population owns 1 trillion, 1/3 of either high net worth or affluent. So this is why Rosecut see us as a mid-market provider. We want to cater to the middle sort of 3 million. And the second point I would make is that wealth is fluid, right? Like it doesn't always stay with the same demographics or the same group of people. So wealth transfer is a big topic these days, and a lot of the older generation gives the wealth to the younger children who basically use an app for everything. If they don't put the money into a Rosecut app, they will put it into a crypto app. So, technology first is kind of how we see to capture these kind of opportunities.
Fantastic. And Sid, I want to come to you next. So digital channels, digital services are, if you like, democratizing access to wealth management. And what will be the benefit of that? So if more and more people can access wealth management, what will be, I suppose, the social benefits?
There's quite a bit of benefits, and I think one aspect to consider is that, like Qiaojia referred to, there's different layers or different groups of investors, right? If you consider some of the affluent or mass affluent market, I think it becomes easier for them to access like sophisticated products which weren't available easier earlier. So, for example, you're getting access to like uncorrelated assets like art, or like structured real estate deals or private equity deals, or even like wine. And those are all uncorrelated assets which weren't available to that segment earlier. You had to have much higher base to start off with. So I think that's like a pretty big benefit to that segment of the market. For the lower end of the market, for the retail market and investors who are just starting out, I think access to like brokerage and simple investment tools has really made a huge difference, as we've seen with all the recent GameStop and all of the other trading things that are happening at the moment. I think like it's a mixed bag with how some of these platforms are set up. There are some, like for example, like public.com, which is a good one, which is focused on building engagement and literacy and community around it. Whereas there are others which are built more on like gamifying it, and at least in my opinion, they don't always result in a positive benefit because it's not really a game. So I think like all these tools are really helping bring wealth management to the fore in front of everyone. But I think we need to be a bit careful on what the propositions are and hope that they lead to positive outcomes for people.
Fantastic. So if I were to summarize what you said, so that it was slightly caveated, but basically, Qiaojia was telling us that there's a very large addressable market of people who don't have access to wealth management, and you're saying that when they do, they'll be able to, get access to a wider range of asset classes, which will help them to diversify their risk or better manage their portfolios to their risk tolerance, and then financial literacy should improve. So it seems like it's pretty much a win-win situation. Yeah. So Nikolai, why is it still hard to convince consumers to sign up for wealth management services? Why is the cost of customer acquisition still so high, for example?
Very good question, and thank you, Ben, for having me, and thank you for being with all of you. Yes, I think there is a bit of a misconception. I think, especially coming from inside the industry, I think we often think that we need to educate consumers more and explain things better, explain things more in more detail. But I'm not so sure that that's actually what will help us here. If you look at some other examples, like I don't know all the details of fractional reserve banking, but I will still get a mortgage to buy a house, right? Or I get a consumer loan to buy a car, which rests on that being a thing. Or if you look at other pieces of technology, at our work we use G Suite, and then I don't really know how Google does it, that I can edit a document at the same time as someone else is editing a document, but I'll still use the product, right? Because it gives me a very material benefit. So, and this product also, it's not sold to me on the basis of its functionality, but on the basis of its outcomes for me. And I think that's, I think the attempt to explain and educate people more, I think we're actually putting off potential clients more than we're encouraging them. So what really I think helps is if you have an UX that focuses on the outcomes instead of the products. I think especially within the asset and wealth management, we're very guilty of explaining the concepts of investment management, the methodologies, the frameworks, the ins and outs of how it works. But for the average client, most of the terminology doesn't mean much, but they're also not very interested in the details. They should be interested in the outcomes and what it does for them. They have objectives, goals, and plans for their life, and the products we build should only be the underlying rails on which those goals and objectives are achieved. And that's the winning proposition, I think. Also, it means to break down, I think, a siloed approach between saving, pensions, protection, investing. Again, we look at those differently because they're regulated differently. They have different revenue streams. Again, for the normal average, especially mass market consumer, it's quite irrelevant because they only care about the outcome, and they should care about the outcome. We should do the mental bridging in between, to get them there.
So, Mike, I'm going to come to you next, and I want to ask you whether you agree with that statement. I.e., is the way to encourage more people to take wealth management services to portray those services more in outcome based, in an outcome based way, right? Where rather than trying to explain to them how the mechanics of how the services work. And then the second thing I'd like to get your view on is the question we've asked in the poll, right? Where people seem to be a bit split between whether or not the pandemic has accelerated the democratization of wealth management. So, if you don't mind commenting on both of those, Mike.
No, I mean, I think these are fascinating areas, very apt in terms of everything that's happening with Tesla, Bitcoin, GameStop, etc. So let me try and react. And to go back to Nikolai, my experience is that the process and the detail matter when the outcome is negative, right? So it's only I always you try and design something for when things go wrong, because when you get a negative outcome, as many people who hold GameStop now the last 2 weeks have, then you got to go back and question your own decision making, the process, the marketing, the messaging from your broker, etc. So I think detail and process are important in that regard. Broadly on the idea of the democratization of finance, I have kind of strong feelings. I rather, in the context of what's happening with Robinhood, I would rather term it the democratization of risk, because that is what really is happening, because you have large savvy players like hedge funds or individual investors who are effectively selling risk to retail investors. Effectively, that's what's been happening with GameStop. When we kind of analyze who's won and who has lost, and people are being exposed to lots of different types of risk they don't know, they've never experienced before. Illiquidity risk in the case of alternative investments, herding and correlation risk. So I rather see this as the democratization of risk. I also think we need to make a very sharp distinction between trading and kind of the volatility of markets, and which is I think much more of an American than European phenomenon, and then the idea of wealth management optimizing portfolios, which is obviously more sane and balanced approach. And I think anything that encourages people to have a balanced, optimized approach to their wealth is good and is useful, and that is, in my view, democratizing finance. So I think the idea of democratizing finance is also, someone mentioned financial literacy, and that's a huge area. The OECD and the EU are beginning to get into this, and for me, that's the real barrier. One of the projects I'm involved in is something called We Invest, Women Empowered to Invest, whose aim is to get women to invest more and to invest better. And in that project, one of the things we found is that men and women have these kind of glass ceilings to finance, in that the finance world talks to them in math and jargon, etc., about what should be products and events that are essential to their lives, like their retirement, but that's communicated in a way that is obtuse and intimidating. So for me, the democratization of finance is really all about clarity and an open and transparent communication.
So we've had a question from Jean-Christophe, but it's about gaffers. So Jean-Christophe, if you're okay, I'm going to take it later on when we talk about new business models, if that's all right, because I think we can tie that into a question about aggregating services. So I'm going to ask the question in this section, if that's all right, because I would encourage other people to please post your questions. But I'm going to put this to you, Sid, right? Because I think Mike is raising a really interesting sort of distinction, right, between the democratization of wealth management and democratization of risk. And my question to you is, if we sort of disembody wealth management from the service providers, i.e., there's this big trend towards embedding wealth services in other channels, right, other distribution channels, do you think that we therefore increase the risk of democratizing risk instead of democratizing wealth management?
Yeah, I mean, I think there is a possibility. Like, for example, if you offer brokerage through a provider who doesn't have like ownership of like the risk in the book, then he is not going to be too worried about like offloading it to as many people as possible. All he's worried about is like customer acquisition or like making a cut on that. So I think like where the risk sits is a very important sort of consideration, and so is the fiduciary kind of responsibility. Like exactly what are you giving to people, and who takes the ownership, like when like Mike mentioned, when things go wrong. So I think like just simply embedding some of the wealth management products without having a strong team to take on the fiduciary and risk and responsibility is actually going to be a bit harder and a bit more complicated than it seems. Yeah.
And so in a model where you have banking as a service provider sitting between the regulated entity, the custodian, and the customer, how does that play out in terms of risk management? Then is that like who manages the risk?
So usually it'll be like the banking institution, the institution that has the license, that will always manage the risk. It's on their books. They're the ones who report to the regulators. So either the platforms or the banking service, the software providers usually don't have the risk on their books, and so that has been, I think, probably one of the reasons why sometimes embedding some of these wealth management services into other platforms takes way longer and way more complex than people think it is.
Great. Okay, right. So I'm going to switch to the second topic, and I'm going to come to you, Nikolai, again, which is we're now going to talk about changing technologies, right? And the question I wanted to ask you is, which are the technologies that are most important in your view in this democratization of wealth management? Do you think it's analytics and the ability to use the trail of data that people leave as they interact through digital channels, to be able to do that whole personalization at scale? So what was once the sort of preserve of the ultra high or the high net worth individual being democratized, so personalization being democratized?
Yes, absolutely. I mean, if we really talk about core technologies or deep tech, excuse me, what is it then? I think obviously it's cloud computing, it's parallel processing, all the things that on which most of the advances lie in the entire software as a service industry generally, of course. But yes, of course, and that along brings with it the use of a lot bigger data sets, and the extension of that is hyper personalization, definitely. And there especially, I think we can draw conclusions also from what's happened in other industries, right? Especially e-commerce, media consumption, where hyper-personalization is the norm by now, where the offering you get is significantly different from what somebody else consumes. Especially think about your Spotify recommendations and the curated playlist you get there. Me, for example, you mentioned Exo Investing earlier that we built in the UK, and there, for example, based on an extremely high degree of automation, the platform builds a unique portfolio for every individual, for every client, for every single client, and then this portfolio is managed on an individual basis, on a daily basis. Potentially, it doesn't rebalance daily, but it could. And that only works, of course, because you have extremely capable server farms. In this case, it could be Amazon or Azure, on which the proposition is hosted. And then at the moment when you need to make the calculations to rebalance the portfolios, you just rent 1,000 more workers, that Amazon gives you at that very second, or a couple of seconds it takes. So that's based on that, personalization becomes a possibility at scale, at very low unit economic costs, of course. I think something else that I'm quite excited about is the context generation through natural language processing, and more importantly, actually, natural language generation. We work with a firm called Personetics, and then there's Cognitive Investment Technologies, a smaller UK player. They do very interesting stuff where, with the means of course, sifting through, again, big data sets, you give the client context to what's happened in the market, how it has affected their portfolio, much like an advisor would, of course, right? So, but again, by bringing down the cost through skipping the human element, you are able to have a mass market proposition. And I think the last one, of course, is classical automation, right? And straight through processing along the entire chain, from onboarding, investment proposals, reporting, etc. And especially there, I think it's also about the fluidity between the products, as I've mentioned before, saving, investing, pensions, etc., but also between the channels of self-service and the advisor, and that becomes one experience. I think that's also, it will be a key in propositions going forward.
So I'm going to come to you next, Qiaojia, and I want to ask you, so Rosecut uses, still it's human beings that manage the investments, but if we listen to Nikolai, what Nikolai is, if I interpret what Nikolai is saying, a lot, like we can personalize portfolios and we can build a bespoke portfolio for everybody, right? That matches their risks and so on. And in addition, it sounds like we're getting closer and closer to doing the thing that's much harder, right? Which is, if you like, the emotional aspect of wealth management, giving reassurance, and that, which if we by using natural language processing and so on, right? So, do you think there's still going to be a role, indefinitely for human beings in the provision and delivery of wealth management services, especially, I suppose, for mass affluent and affluent customers?
Yeah, that's a really question that's been debated, within the digital community for the past 10 years or so. And I would say, first of all, I want to make a distinction between personalized advice and personalized portfolios. So I think for financial advice, it should always be, personalized to your, circumstances, your long-term life goals, your income level, your different, even wealth personality, right? Am I a legacy kind of person, want to maximize my wealth and pass down to my children in the most tax-efficient way, or I'm a freedom type of person who just want to earn enough, right? So in this case, we help you to define what is enough for your personal circumstances. I'm of the view that this is much more important than personalized portfolios. The traditional industry has come a long way, from bespoke the portfolio and doing advisory services, and frankly, sometimes does not actually match the efficiency or the return for the client. It's like you are a chef and asking the customer to detect how you cook the meal. It does not always work very well. So for us, we think standardized portfolios, with certain customization element, but not necessarily bespoke or personalized, might really attract the affluent people. So this is why our discretionary offering has a standardized element, basically model portfolio, and then let you pick some interesting semantics, very much related to what Sid was saying, that the alternatives can play an interesting role here. So going back to the personalized financial advice bits, if you think about the different type of client needs, as well as sort of the cost of human advisors, these are the two most important things that's driving the industry change. So, people joke about going to see a wealth manager is like going to see your dentist every year, right? Like, it's the right thing to do, but it's painful, and you really don't see it. Private banks throwing Michelin lunch and dinners and entertainment to make it slightly better, but still, not everyone wants to sit down to go through 2-hour, integration of, what's your assets, liabilities, and those kind of topics. So we actually found a lot of people enjoying a quiet time, sitting at home, just going through that step by step at their own pace, rather than being interviewed by a wealth manager. So I think a digital service is in a great place to capture those kind of preferences who are sort of incremental wealth to the industry. And second is about the cost of advisors. Because since RDR, there is such a decrease in the qualified advice space, and advisors are retired, basically retired with some of the older kinds. So if banks can't make a living by providing bespoke advice to affluent people and then sort of dropping those clients, then digital providers can't either. And this has been evidenced by, some of the first generation robo advisors having a hybrid model, hiring financial advisors to provide advice on hourly basis. So Rosecut view is that we, first of all, want to automate as much as possible, right? Like to build a beautiful user experience that, as close to social media experience where you have the emotional element as well as possible. Of course, we still have a long way to go. And then we use human as insurance. So anything that the automated platform doesn't do, we have the human advisor to pick up the slack. And over time, with the trend and the learning from those sort of unanswered questions, you patch it up into the system and make it more and more sophisticated.
Mike, I want to come to you next because thank you very much, judges. So because I think so far we've been sort of thinking about the wealth market, and we've been splitting the demographic almost by how much money they have, right? So are they affluent, mass affluent, and so on? But it's more complicated than that, right? Because as you said before, there are other demographics you can layer on top, such as women have different preferences, but to men, younger generations have different preferences to older generations, and so I wanted to ask you a question that's come from the audience, right? Which is, if we assume that some of these robo-advisors, they have a high cost of customer acquisition today, for example, and they target, say, mass affluent or affluent, what is their possibility to grow with the demographics, whether they slice them in different ways, so they target younger generations who are mass affluent, who may over time accumulate more assets, and so how do you see the possibility for some of these new entrants to kind of move upstream into high net worth or ultra high net worth? Yeah. And that may be either by targeting to a different demographic or growing with their existing demographic.
Okay, so I think that there's maybe two things here. One is the various changing demographics, and then the other is the business model and how you capture that. And I think some online banks and online digital wealth new entrants to the digital wealth management marketplace have made a mistake in paying up far too much in terms of customer acquisition costs. And you see that in some of the results and some of the fund runs they have. To kind of give Rosecut a little push, the model of kind of focusing where the experience of the team is, which is sort of high net worth, works, because you don't rely on sort of buying ads and reaching out on social media. There's an element of kind of personal contact as well. So first of all, on the demographics, I think in general the wealth management industry is very poor at demographics, and I kind of scold banking colleagues in old banks by saying, you go to a supermarket or a shopping center or go to the high street and you look at how well luxury goods companies or retailers target different demographics, and banking doesn't do that. It's lazy in that regard. And in the future, I think we will have more attention on younger niche, on older niche. The topic of longevity would be a really big issue in wealth management, pensions, the accumulation of wealth, and then also women as a demographic is an area that banks, in my view, haven't given any attention to at all in terms of the services. In terms of business models, I don't think that digital banks who are currently focus on mass market can really move up to the higher end for a whole load of reasons. One is you need to hire humans, you need to hire bankers with experience, you need to have different products, a different product range, and probably a different platform. And I think most of the people in the high net worth space and upwards, they want a focus on them. They want something that's maybe less transactional. They want something that's sleek in terms of the service, but that's less transactional. And that's a very, very different proposition if you're kind of more of a mass banking app. And I think the problem for those companies is that they are increasingly going to be encroached upon by what individual banks are doing with their own digital projects.
Just one follow-up for you then. Does that mean you think we'll see churn? So in other words, as customers get wealthier, they'll switch from robo-advisors potentially to private banks when they demand a different type of service, in person and so on.
I think that will be the case, depending on the extent to which they get wealthy or not. And I think what will also happen is that some wealth managers will become better at IT, so better back office. Nick has talked about some of the solutions, better reporting, really basic things that many wealth managers don't do very well. And I actually think the biggest revolution will be product and access to what I would call kind of the portfolio of the future, which will have more private assets, probably more crypto, and be a bit more international. And if you look at the offering from new and old players, not many of them have that.
Fantastic. So, Sid, I want to come to you next. There's a nice segue there because Mike's talking about sort of broader portfolios that extend beyond some of the traditional assets. And so the first part of the question I want to ask is, we've had two really good questions here that I want to put to you. The first one is around the role of tokenization in opening up some of those asset classes. I think you briefly touched on that before, but if you wouldn't mind picking that up again. And then the second part is around gamification. So what is the role of gamification in terms of keeping people engaged with wealth management services? Because I always think about banking as having this engagement challenge, which is, it's principally a transaction-based service, therefore it doesn't have high levels of engagement, and therefore it's open to being embedded in channels that have higher engagement. So the two-part questions, tokenization, and do you think gamification might provide enough engagement to keep people using wealth services from wealth managers?
Cool. Good questions. I think the tokenization can definitely help, especially with alternative assets and like allocating ownership in a fair and equitable and a transparent way. So when you're talking about art, when you're talking about wine, when you're talking about obviously crypto is where that whole thing originated from. I think tokenization can really help with access to some of these assets which were reserved for the ultra high net worth in the past, and I think that will definitely be a trend that takes hold. In terms of gamification, I think there's definitely room for it. I mean, for me, I think financial literacy is a really important aspect, and academic research has shown, like, for example, that in Europe, only about 30% of the population has even basic levels of financial literacy, and it's about the same in the US. And these are affluent, like OECD nations. And simple things like time value of money, about saving, about inflation, teaching people about having a savings account and having an emergency fund, just inculcating some of those habits, those basic financial literacy habits, can make a huge difference in their financial outcomes. And I think gamification for positive cases like that is really important. I think you have to be a bit careful where gamification doesn't become about getting people to trade more, and I think that is something that I'm quite wary about. But in terms of increasing the literacy, getting people to save more, getting people invested more in equities, but more as a portfolio rather than individual stocks, teaching people about those sort of risk-return trade-offs and better financial habits is where gamification can help.
Fantastic. Okay, so I'm going to switch now to new business models, and I'm going to going to combine my questions because we've had some good ones here also from the audience, right? So I think what I'm going to do is I'm going to kick off with you, Mike, if that's all right. I'm going to ask you, what you might argue that wealth managers or wealth management potentially has lower engagement than some other services, right? Through which you could distribute financial services, but it has a high level of trust. And you can use trust to aggregate other services, but we see very, very few examples of aggregation models in wealth management, by which we mean, using the pull of an existing customer base to aggregate wealth and non-wealth services. So why don't we see more aggregation models from big private banks, for example? Why doesn't UBS, for example, aggregate other services?
I think it's a good question, and the answer for me lies largely in sort of the area of organizational culture, and lots of we're beginning to get consolidation in wealth management in the UK, the rest of Europe, Switzerland, where we are today. And the logical question is, why doesn't Google buy UBS, or why doesn't Amazon buy Credit Suisse? Because what you're buying is the brand, the top level expertise. You come in, you clear out all the tech problems. And I'm not a tech person like Nick or Sid. I'm a kind of a bystander in that regard, but I see kind of various things happening across the industry. And there are big barriers in terms of banks doing tech well. There are lots of interests on the part of people inside banks in not having tech disrupt their own jobs. In Switzerland, we have an issue with data. So banks prefer to do projects internally that are simply inefficient. And then I also find that many tech people, particularly in fintech, have very logical solutions to what they think are banking problems, but actually what they don't spend enough time thinking about is the idiosyncrasy of the banking problem, and the fact that banking customers like to have humans rather than robots addressing them, etc., etc. So there's lots of reasons why the two don't meet. And I think that the most interesting space would be crypto, because that would be tech, if I can call it tech banking or tech money, designed by tech people. So it's entirely consistent within the ecosystem. And in Iran, from Zug to Zurich and other parts of Switzerland, lots of people begin to set up crypto operations for trading, for digital asset custody. So that space is a very interesting kind of proving ground. But yeah, to come back to your question, there should be a logic in some of the bigger wealth and asset managers who trade at quite cheap valuations, particularly compared to similar operations.
Yeah, totally, yeah.
Just being bought by tech companies or tech entrepreneurs who can potentially cut the banking costs at least in half by introducing a kind of a much more rational, tech-focused approach. Finally, just to not to go on too much, I think the disruptor to the industry will be consumer goods companies and platforms getting into finance, probably from the bottom up. They will have a scale, and they've already solved the customer acquisition problem, right? So it's a question of just starting with a range of sensible products. So that's where the threat's going to come from.
Okay, which is a super segue to you, Sid, because your business model is basically in facilitating that, right? Which is facilitating non-banks to offer banking services, or in this case, wealth management services. Do you see that already happening? Or what is the level of demand for embedded wealth management services? And you kind of alluded to this earlier on in one of your answers, but it seems like it might be more difficult than people think. So would you mind elaborating on that as well?
Yeah, so I mean, getting started with the wealth management product is hard. When I had a startup and we were setting up a brokerage, it took us almost 2 years to get a license, get all the legal agreements, get everything set up. I think having an embedded finance option, like some of the new platforms like ours, which are coming up, make it a lot simpler. They kind of abstract away some of the complexity, some of the compliance, some of the security. So I think that whole process can really be sped up. I think there are still roadblocks, and those are related to who takes on the fiduciary responsibility, who has the licensing, and that is always going to be a bit of a problem in wealth management. So, for example, with some of the embedded services that we are offering, we are finding that a lot of financial advisors are calling us about them. They already have the licensing, but they want to make it they want to have a mass acquisition channel. And so, for example, they want to offer an aggregator or a small calculator or risk analysis services on their website, and that serves as a acquisition tool for them. So I think in those sort of cases, having an embedded finance solution works well. We're also finding that platforms that are starting to take on more of the financial services burden of a particular segment. So, for example, freelancers, for example, there are people who are building payments services for freelancers because a lot of them don't have even bank accounts, and so we're setting up facilities to have bank accounts, but then why not add an extra feature where you can also allow them to save easily. So having an embedded solution which they can get up and running quickly is a real value add to those types of companies as well. So we're seeing a mix of both. We're seeing both financial services providers who want to acquire people cheaply, and non-fintech companies as well who want to start dipping their toes into offering some of these services to their customers.
Thank you very much. Nikolai, I'm coming to you next. So I want you to, if you don't mind, expand on this topic by talking about some of the interesting business models that you see, the kind of customers that are coming to Nucoro. And I want to just frame it slightly by talking about these many-to-many network type models that Sid touched on there. Can you take a pool of freelancers and help them to save between to build a collective savings pool, for example. So I just wonder, other models like subscription services and things like that we start to see emerge in wealth management. So can you just comment on what you're seeing in new business model types?
Yes, absolutely. I think it's a very interesting question because it's only remotely related to tech, actually, the business model, and which is a much more strategic topic and less tactical, and often overlooked. I think actually that there's a lot of potential for innovation. Yeah, totally. I think the fee models are an interesting one. Rosecut is a great example, right? Have a freemium entry-level model where you dip your toes in, and that probably then draws you into the actual corporate position. But generally, the move from AUM-based models or even performance-based models, I think, to flat, predictable, subscription-based fees, which is what consumers are by now very much used to, right? And a lot of the other services we consume, digital and non-digital, starting, with, again, I mentioned it before, just Spotify subscriptions, Amazon Prime, everything else, obviously. I think and that relates a bit to what you just said. I think it's this, the idea of building ecosystems and making connections with other services and cross-selling across the services. You think of the challenger banks there, like Revolut does this natively within their app. They switch another tile, and then there's insurance. They switch another tile, and there will be investment management. That's, of course, and they build a lot of these things themselves, but not necessarily that needs to be necessary, right? You can still offer this functionality, but rely on someone else to actually have the capabilities of technologically doing it, but also from a regulatory perspective doing it. It will still be the service that you will be the gateway to that service. So building connections with other distributors in not only the direct approach, I think also plays into that. And there's a bit of a fear and a concern around being commoditized in a way. But however, and also coming to Michael's point earlier, right, the biggest attack vector comes from for example, the big tech players, and Google will not become a bank, but Google or Apple will be the biggest distribution partner you will have, and you can possibly find if you are a bank. So overlooking that, I think, can be a lethal mistake as well. And then I think it's also about is very strategic and very business motivated. It's about building a flanker brand maybe, or a sub brand, and really moving away from and giving up a bit of the brand equity you have potentially. Because having an established brand is a great asset, but it can also be a liability if you want to reinvent your offering and reinvent also, probably the target groups that you have. The biggest players are doing it, right? With Marcus by Goldman Sachs, now JP Morgan is rumored to launch something in the UK. Of course, those are big firms with a lot of brand equity, but still, I think it plays to think about that also for mid-sized market players. And all of these, and I'm aware of that, like all of these are a bit harder steps, and I think we often a lot more comfortable, to tinker with internal processes and tech and all the stuff that the clients don't really touch. But I think it pays to be bold and attempt some of these more strategic transformation plays, really.
Ben is on.
I can't hear you.
Forgive me. Right. So I want to put the next question to you, Qiaojia, which comes from Ian Stewart, and he asks, which of the incumbent financial institutions are the most progressive and making the most progress in this area? So, kind of picking up on Nikolai's point, who is taking the risks? So we've heard about Goldman Sachs launching Marcus, and now Marcus is also the platform was also now offered to others. So Goldman Sachs is potentially taking some risks and being quite progressive in this area. Who else do you think is kind of leading amongst the incumbents?
I probably wouldn't say there's one single leader in the space, and we have seen sort of an influx of incumbents trying in this space in the past 5 years. I think UBS spent a huge amount of money launching the smart UBS Smart Invest, and then actually the head of that program is one of Rosecut advisors. So we've learned a lot from their experience. And Coutts, have launched their mobile app with the basic functions a couple of years ago, and sort of piloted a program called Coutts Invest. At the beginning, it was only open to Coutts clients, and then eventually was distributed under the RBS and NatWest name for RBS NatWest Invest with £500 to start with, benchmarked against Nutmeg. That I suspect. So I think one of the key things is that people in the incumbents, are worried about things like, wealth transfer and how not to sort of be left behind with the digitization of the service. But they face two challenges. One is a legacy IT system. It takes forever to build something new and then bolt onto the old gigantic machine. Right, so in the case of UBS Smart Invest, it took them 18 months to do that. And for Rosecut to have a fresh state-of-art tech stack, it took us like 6 months, right? So this is the level of challenge. And second, in my view, it's always easier to start an evolution. You can be an independent, almost like a single cell creature, and then improve, rapidly iterate your offering along the way, then starting a revolution within the organization. Because you always are fighting against the sort of, people who prefer the old ways of doing things, and that rarely goes successfully. And another point is that, a lot of the times incumbents treat the digitization as a back office problem. So they see it as an IT project that, throw a bunch of engineers, then it's going to work. At one of the major banks I worked, I really, squeezed into the digital offering team out of my normal KPI and try to contribute a front office perspective. They think it's an architectural issue. It's not only an architecture issue, it's a user experience, client experience issue as well. So I think this is where you see it happen again and again in other industries where independent, small, scruffy startups eventually overthrown the established companies. And this is, personally why I made the career switch and trying to figure out, independently. But that said, I have not seen, I would say Marcus is probably the best example of mostly investment bank trying to get into a more mass market, and they have their a good sort of strategic plan of investing to Nutmeg, doing a saving product, and now moving to investing.
And what about somebody like Standard Chartered? Because they seem to have a similar kind of playbook, right? With Mox, and I think they've got this new platform called Nexus, right? Which is a bit like Marcus. And I suppose this is open to anybody to answer, but it seems like Nikolai was making this point that if you're a large bank, launching a new kind of your own challenger brand is a way of, if you like, transferring some of the brand equity you have into a vehicle where, to your point, Qiaojia, you don't have the problem of legacy IT, and to your point, Mike, you don't necessarily have the same cultural obstacles to introducing change particularly around business models. So is that the best way for an incumbent to kind of face up to this digitization threat?
Maybe I think one key element there is also that from a culture perspective, it's the only way that innovation on a technological level can work, just because within the organization you have cultural bottlenecks, but especially what Qiaojia said, right? You have the legacy system bottleneck that just prevents you from being able to do any meaningful change at a scale where it makes a dent in what is the consumer outcomes in the end. So and I think there's good and bad ways to go about it. And I have dealt, and we deal a lot with the innovation labs or the digital arms of the retail banks have set up. And that's kind of also to Qiaojia's point a bit. It's also the way of looking at technology as something that happens outside the business and then somehow goes back into the business and then change happens. But I think it's great as a channel to introduce innovation or source ideas for innovation, but it's not what drives true business model transformation. If you want to truly build a digital first proposition, the business and the tech have to evolve and be built in sync. And that's exactly what challenger brands are doing. This is what Revolut is doing. This is what what Rosecut are doing too, of course, right? It's what all of us are doing when we are building a new startup, but also a new technology stack. So by creating a sub-unit or an outside unit, I think it's probably the only way to do meaningful change that really then has a transformation curve that is not just like a band-aid to what is essentially a very heavy wound.
Because you're right. Because Qiaojia made the point that a lot of banks kind of view digitization as a back office function.
Yeah.
And then on the other extreme, you've got a lot of banks that sort of see it as some sort of innovation function, right? Which, a plaything for a group of people who aren't really, key decision makers in the organization to work with, right? And it needs to be in the very top of the corporate agenda. And so how do you do that? How do you make it top of the agenda? Do you hire people that aren't bankers to join the board, for example? No. What is the way to do it?
I mean, maybe I'll chip in. Please. I have to say the Rosecut experience opened my eyes to how bad the big banks were with tech and how good a small focus team can be. I'm now going through the same experience with the We Invest startup in terms of me learning about lots of different areas. So I think the decision here will be made by the CEO of a large bank. So I think the kind of thing you want to do is to take some of your senior executives, make it clear to them this is an essential part of their career, that they're not just being parked in operations. You want to incentivize them. You arguably want this to be geographically remote from headquarters to give a sort of a mental break. I think you need to put tech and banking people together on parity. Maybe I think have a lot of interactions with customers and potential customers, just to make absolutely clear what the problem you're trying to solve is, and try and do it in that way. And maybe also put the bankers through tech classes, entrepreneur class, and teach banking to the tech people as well. So it's something I think in which people have to be very, very invested, but it should pay dividends.
And do you think banks can attract the right tech talent? Because if the competition for tech talent is global, because tech is part of everybody's business, or arguably the most important part of everybody's business, can banks hire that tech talent, or should they be using third-party suppliers like Hydrogen and Nucoro more than they do today?
Let Nick answer that. I mean, tech talent is already very expensive, and in London and Zurich and Zug, tech talent is as expensive as banking talent. I kind of think what you want to hire, just my limited experience, to hire kind of project managers who have a taste of both and can actually advance the project, who are kind of fluent in both languages. But that's not an expert opinion.
Fantastic. And then, Sid, a question I want to ask you, right? Because I'm sorry to keep coming back to you on these questions of embedded banking, but I just think it's fascinating as a new business model type. And I'm just wondering, if banks or wealth managers in this case, or pro banks, right, don't control the customer interface, i.e. that's controlled by another brand, how do they continue to have a profitable business where they have some control over pricing, some ability to upsell and cross-sell? Or do they have to accept that they're just balance sheet providers, or or custodians or whatever, right? Or regulated services providers? What is the role of wealth managers in embedded banking world? And then how do, if they do have a profitable role, how do they bridge between being a back office supplier and having some engagement and continued role with the customer?
Yeah, it's a tough problem for them, right? And that's why some banks have not gone down that route of just providing the services. Like in the US, you see most of the fintechs are using only a couple of banks, like Evolve or like Green Dot as the back end.
Yeah, across river in your case, right? No.
Yeah, across river. So there's just a handful of banks, but none of the big banks, right? But for these smaller banks, who had a much smaller customer base, for them it gave them access to a huge amount of customers, which they would have never had access to previously. So for them, it kind of made sense to build a tech stack specifically for integration for the fintechs, where it's a scalable kind of solution for them. So they're still making money, and they don't have the customer acquisition costs. So they can it can still work for them. I mean, it becomes obviously a bit harder to cross sell anything, but I think just in terms of the scale that they can access, it's huge, and it's worked really well for people like Cross River. I mean, their scale is just grown dramatically in a couple of years.
Yeah. Okay. So I actually looked, because we've got a report coming out, wealth management report next week, and I looked at some of these smaller banks in the US, and some of these guys have got return on equity of 40% plus, right? Because as you say, right, they don't have to acquire the customer; they're just providing regulated services. But it doesn't seem to me that would work very well for an incumbent, with the kind of cost base that an incumbent has. So is an incumbent, this is a question to anybody to answer, is an incumbent therefore with a large customer base, with a large cost base, excluded from participating in embedded finance? Or is there a way to kind of leverage the brand to make it such that if I'm using a third party service, I still would want the service from a given institution? In other words, is there a way to sort of still differentiate when you don't control the customer channel? And how is that possible? Is that a tech question? Is that
I think there's just one aspect. I'll give to one example, which is the Apple Card offering, for example. Right? You had Goldman Sachs was still involved in that, and they weren't at the front of that brand offering. But what they were able to do is were able to take on some of the risk assessment of clients and maybe offer it. I mean, and that worked out poorly in some examples, but people were able to see that they were able to get cards much easier. For example, it also gave them access to a huge channel as well. So I think there are some possibilities of being embedded and still having the visibility and some control on the proposition that you're offering. But it becomes challenging. I think now, like a couple of the banks are trying to offer banking through Google as well, and there've been some deals that have happened over there. But they'll just be in the background in that case. But it's a huge customer acquisition channel for them.
Does anybody else have a view on that? Because it seems to me that implicit in what you're saying with the Goldman Sachs Apple tie-up is, you have, if you like, two premium brands. Like, is it just about building brand, or is it? Do you think there's a tech answer to it? I suppose is another way of putting it. Like, if I can build sufficient contextual information and I can serve up relevant offers and content and so on, even if it's through somebody else's channel, can I still carve out some differentiation that makes me more than just a commodity supplier of regulated services? Is that? And I'm curious to know if you think that's a tech challenge, brand challenge, or whatever.
I'll chip in a few of my observations. On the tech side, I think it's really challenging because of the legacy system, and the executive team may not have the courage to, put down a couple of billion and do a complete overhaul. But what are the things they could have done is to really sort of reshape the sort of incentive system. One thing that a private banking colleague put to me in terms of the private banking model, she described it as a hair salon model. Every advisor has their own desk and has their own support and look after their own group of clients. So it started this, a bad habit of banks, I'm talking about specific private banks, poaching each other's high producers and pay them a lot of money and hoping to attract the book. But overall, it's not a very structured effort of growing the organization together. So, this is one thing they could think about, how to incentivize team effort, rather than rewarding lone wolves. This is something that we can think about. And second is that when you face, regulatory pressure and margin compression, while you race up to the top of the pyramid and dumping your smaller clients to solve the regulatory pressure, then, it's rather than doing the reactive thing, it's more important to be really clear who you are focusing on, right? Like, it doesn't mean you are a big bank. You should be just thinking, okay, I'm catered to everyone, have a tiered offering, like some of the British banks of retail, affluent, and then high net worth and ultra high. You really need to think about how you're going to do that, right? Maybe outsource your lower tiered clients to some partners, and then focus on the most important segments that you have the right skill and expertise for. So, UBS went through the process of, well, let's try to dab into affluent. No, actually, we should just focus on ultra high. And a lot of other banks feel like they should focus on ultra high now. But there's only so many ultra highs in the world, right? Like, you can even slice down the target market to entrepreneurs or certain industries, or just to really have a good view of what you can do, on a more organized effort and reinforce your brand in that. So this is a non-tech perspective.
Yeah, no, and I think, the cultural questions again, right? Which, so Mike, you seem to be, have strong opinions on culture. I mean, is that possible? Like, moving from the hair salon model, kind of, split, if you like, outsourcing customer management, all these things, again, to be quite alien it seem to me when I speak to private banks to be quite alien to their thinking, right? Because they still think that they are in control of the customer and the fulfillment of those customer needs, right? Front to back.
Absolutely, and that's even reinforced by the individual bankers. I mean, they will jealously guard their clients and their customers. And I think, just to go back to your original question, which was, I think, if you have a high cost base, can you put in place some of these changes? I mean, my response to that would be to ask why you have a high cost base. Is it a defunct business model? Is it the wrong blend of bankers? And that kind of thing. So when you end up in that situation where you have uncompetitive margins, outsourcing tech might be a solution, but the real problem lies elsewhere. It lies in the core management and maybe institutional, cultural issues that are very, very deep seated. And I think even if if you walk into a wealth manager in, say, Switzerland, they all look the same from the outside. The people who meet you all look the same. And to the extent that it's becoming a bit of a parody, I think. And that maybe tells you that these cultural elements are very, very strong, and that trying to change them will meet a lot of resistance.
Maybe just one.
Yeah, sure.
We could add something there. Because also coming to your point, Ben, that you said, introducing certain elements or changes is foreign or is met with a lot of skepticism. What I find interesting is that a lot of times it's very difficult for them to articulate what is actually the value that clients see in us. A lot of them don't really know actually. Is it because a rather trivial element like customer servicing, for example, on the middle office side, for example, you might think that it's very important, but your clients maybe don't see it as important at all, right? It's maybe other elements. Maybe it is the status symbol that the brand represents, or it is the user experience or the personal relationship with your advisor. It might be a very wide range of things, but a lot of times they don't know. And I think that's the starting point where a lot of the analysis has to actually first figure out what is it actually that your clients like and see as the value that you add, and then maybe you can actually only have a discussion around not doing all the things that you think are necessary to do.
I think that brings us to I think probably the last question that I'll ask, which comes again from the audience, comes from Christopher, and it begs the question: what is the ultimate role of a wealth manager? Because underlying his question, I think underlies his question because he asks, are technology solutions sufficiently sort of advanced that a wealth manager can outsource the entire thing to a technology ecosystem, and then what would be the USPs that remain? So if you like, if I'm a wealth manager and I'm in charge of the brand, can I source everything else from an ecosystem of tech providers, fintech providers, etc.?
Yeah, I think at the very high end you can't. At the high end, what some banks are beginning to do is to bring corporate finance bankers into relationships with families and family offices, and that kind of stuff can't really be commoditized. It can't be sold through tech. So if because I think at that level of clients, they want security and they want advice, and they want the bankers to know them intimately, and you can't do that remotely, you can't do that through technology. And that kind of advice on networks or finding a business to buy and sell, that's not something to which tech has got a solution. And I think also for senior bankers, they often play a sort of sparring partner role. So for the very top end, I don't think that's possible. I agree with Nick and Qiaojia. For all of the operating stuff, it should absolutely be made as efficient as possible.
But if I interpret that correctly, you're saying that beyond the people that serve the ultra high net worth individuals, or the family offices, whatever, everything else theoretically could be, because you're saying ultimately it's a question of scale and therefore lowest unit cost and access to networks. And
I think most of it could be, and I think obviously as you go down the scale of client base, the more tech you can deploy. I think you also want to think about content and education. And content is not something the banking industry does very well. Most banks, people can't look at Twitter. No bank I know does research on TikTok to be slightly funny about it. So I think there's actually huge scope there, not to make things more efficient, but to make things a bit more clear and more entertaining as well.
Okay, interesting to say entertaining. How do you make absolute last question, and then we'll wrap this up. How do you make wealth management more entertaining? I'd like to get everybody's views on that.
Just one example I have about gamification. My girlfriend is learning German at the moment, and she uses Duolingo to do this. It's a very, very popular language app on the iPhone. And every evening, so there's a daily league basically. Every evening before 12 o'clock, if she didn't manage to do it during the day, she will go online and just rush in some sessions to improve her scoring for that day, to end up, among the top 10 of her league, however that league is built, I don't know. I think there's a lot of literature around, what are the best ways to learn a language, what are the most efficient ways to memorize vocabulary, etc. You could do a lot of theoretical approaches to that. The app solves it in a very different way, right? It is a very compelling, fun way to bring you back to, get in, maybe 10 more words or something. I think to draw, we don't have to reinvent the wheel in wealth management, but to draw inspiration and insights from other sources, and maybe if the language learning app from where you take it from, I think that's actually a starting point, because we're a bit behind. Others are a bit ahead of us in making their experiences more fun and entertaining.
And then how would you gamify wealth management without introducing, democratization of risk, to Mike's earlier point, which is, it seems to me, if you can't gamify, I want a higher return on my portfolio, because then you're changing risk. So it's gamifying what aspect of wealth management? It's savings, because that seems external to wealth management.
Right, absolutely. You're totally right. It must be different levers than only the risk lever. But then you have, again, we see approaches like that already, right? It's about roundups,
yeah.
Saving. We see fun ways to, one set a goal, and then you see just visually how that goal materializes in an app, and it becomes more tangible for you. I think there is ways that are not really too risk-taking and more risk.
Yeah, maybe there's an intergenerational play, right? Parents or grandparents helping, children, grandchildren to save, to invest, sensibly and so on, which might help with the intergenerational, risk of attrition. But I don't know.
I think the social aspect can be can be very huge, especially for the new generation. And I think we saw that with some of the Reddit boards and stuff.
Yeah.
But if that can be harnessed in a more positive sense, where you have peers and maybe some interesting people who are talking about finance, talking about investments, and you're kind of working with a group to kind of solve your financial problems. I think that is going to be some of the new kind of fintech platforms that we're going to see in the future, and we're already starting to see some of those. They're just starting to get funded now. So
perfect. Great. Okay, so we're almost out of time. So I think all that remains is to thank the four of you very, very much for taking part in this discussion, to thank everybody who has listened to this either live or the recording. And then just to remind you that if you enjoyed this, next week we're going to be double clicking on the new business model aspects of wealth management, and we're going to be joined by Elinvar, Impact, Tinkoff, and Additive for that discussion. So thank you everybody for participating and taking part in this, and see you at the next 4x4 virtual salon. Thank you very much.
Thanks everyone.